Investment and Digital India. Market, risks and opportunities. The new India is young and hungry for fast-growing investment opportunities. Current-day investors are on the prowl to expand and diversify their portfolios with newer investment opportunities. In the light of that, in what ways have investment opportunities for the Indian investor evolved and changed over the last few years? Technological progress and its increased adoption for investment purposes have enabled traditional assets to be made available for investment in different formats. This is providing investors with a wider choice in how they structure their investment portfolio. A great example of this is exchange-traded funds or ETFs. ETFs are essentially funds that hold a bunch of other underlying assets and can be traded on an exchange. They are similar to stocks when it comes to their ability to be traded on an exchange and different from them in the idea that they hold more than one underlying asset. Though having been around for decades, ETFs never really grabbed the attention of non-professional investors. With the investment process becoming heavily digital and online, the last 10 years have seen a rapid increase in ETF investments. Another avenue that has been intriguing investors is the arrival of fintech assets such as NFTs, non-fungible tokens, and cryptocurrencies. NFTs, in their basic sense, are tokens or units of data that are unique and stored on the blockchain. Though they are a more recent phenomenon, they have been quick in establishing their value. They are in fact now being seen as a legitimate and meaningful investment option in their own right. But as exciting as they may sound, investing in NFTs and cryptos does have its own set of risks, just like any and every investment opportunity or asset class. It is critical as an investor to understand the investment thesis before you go ahead and buy any bitcoins or any NFT art. With them being new financial assets, the investment thesis supporting their investment and their key drivers of value are still evolving, and more often than not, are still poorly understood by many. A major hurdle for investing in NFTs and cryptos are presented in the form of legal and regulatory challenges. Any changes to the law could materially affect the valuation of these assets. The same growing and changing technology landscape that has allowed for these assets to find a market and flourish can itself spell trouble for them too. Imagine a scenario where a new disruptive technology manages to penetrate and break down blockchains that would effectively put an end to cryptocurrencies as we know them. Another factor to consider before investing in these new age digital assets is the impact of market liquidity on their valuation. For example, NFTs are still highly fragmented and lack well-developed marketplaces to trade. Their valuation, therefore, is susceptible to significant changes due to a lack of market liquidity. The value of an asset, in many cases, is driven by the number of interested buyers and sellers of the asset. When the buying or selling interest is thin, it has the potential to have a direct and negative impact on the valuation of the asset. Some argue that the growing trade volume of digital assets take care of the market liquidity problem. While this might be true for the top 3 to 5 traded cryptocurrencies, this doesn't really apply to NFTs, at least as of now. Minting of NFTs does not translate to healthy market liquidity, as this does not necessarily indicate buying interest in the secondary market. In a fundamental sense, ETFs and NFTs are similar in that they offer fractional ownership and tokenization of financial assets. ETFs have been slow in establishing themselves with healthy market liquidity in India, but their status of being regulated by the authorities gives them stability. NFTs lack a regulatory framework, and their highly fragmented nature presents challenges in investing in them with complete confidence as of today. This is not to say investing in NFTs might not pay off, just that investors need to be cautious and not just go with the hype. In India, ETFs still represent a small portion of the market and still remain vulnerable to their valuation, diverging from the underlying stocks during times of distress. However, considering their growth in the West, their cost effectiveness, and the returns they can potentially provide makes ETFs bullish in India. The pandemic has given ETFs some fresh impetus with increasing interest in the past 18 to 24 months. Given the rapid rise of ETFs in the last 2 years, there is a strong reason to think NFTs also have a promising opportunity, considering they too offer tokenization. Indian investors now have options to invest in a wider pool of investment opportunities and asset types. Prudent risk management dictates that one takes into account all of these risks before investing. Just like when investing in any other asset class, investing in ETFs, NFTs, and cryptos need a thorough understanding of how they function and what it means to invest in them. A smart investor considers all the information available at hand. They make calculated judgments on whether investing in a particular asset is for them and if they have the appetite for it. With all that said and done, there is a definite reason to be optimistic about these growing and emerging digital asset classes.
Want more information? Visit us at www.herowired.com.